Investing in bonds can be a great way to diversify your portfolio and earn a steady stream of income. Whether you're a beginner or an experienced investor, this video will guide you through the steps you need to take to start investing in bonds. First, it's important to understand what bonds are and how they work. Bonds are essentially loans that investors make to corporations, governments, and other entities. In exchange for the loan, the borrower agrees to pay the investor a fixed rate of interest over a specified period of time. Next, you'll need to determine your investment goals and risk tolerance. If you're looking for a stable and relatively low-risk investment, you may want to consider investing in bonds issued by the government, such as U.S. Treasury bonds. On the other hand, if you're willing to accept a higher degree of risk, you may want to consider investing in corporate bonds or high-yield bonds. Once you've determined your goals and risk tolerance, it's time to start researching the bond market and individual bonds that match your investment strategy. This might involve consulting with a financial advisor, reading news and analysis from trusted sources, and comparing different bonds based on factors such as interest rate, maturity, and credit rating. Another important factor to consider is the bond's yield. This is the amount of income you can expect to receive from the bond, expressed as a percentage of the bond's face value. A bond's yield is influenced by several factors, including interest rate, market conditions, and the creditworthiness of the borrower. When investing in bonds, it's also important to consider the bond's duration, which is a measure of the bond's sensitivity to changes in interest rates. In general, bonds with a longer duration are more sensitive to interest rate changes than bonds with a shorter duration. One important factor to consider when investing in bonds is the credit quality of the issuer. It is important to research the financial stability of the issuer and consider their ability to repay the bond's principal and interest payments. A high credit rating from a credit agency such as Standard & Poor's or Moody's can give an indication of the issuer's creditworthiness. Another factor to consider is the type of bond you wish to invest in. Government bonds, municipal bonds, and corporate bonds are all types of bonds with different levels of risk and reward. For example, government bonds are generally considered to be the safest type of bond, while corporate bonds can offer higher yields, but with a higher level of risk. The maturity of the bond is also a key factor in determining its risk and potential return. Longer-term bonds are generally considered to be more risky than shorter-term bonds, as they are more sensitive to changes in interest rates. On the other hand, long-term bonds often offer higher yields than short-term bonds, making them a good option for investors who are willing to accept a higher level of risk. It is also important to consider the yield and coupon rate of the bond. The yield is the return you can expect to receive on your investment, and is calculated as the annual interest payment divided by the bond's price. The coupon rate is the interest rate paid on the bond, and is typically expressed as a percentage of the bond's face value. In addition to the yield and coupon rate, it is important to consider the bond's call features. Some bonds can be redeemed or called by the issuer before the maturity date, which can result in the investor receiving less than the face value of the bond. Investors should consider the likelihood of a bond being called and its potential impact on their investment before making a purchase. Another factor to consider when investing in bonds is the liquidity of the market. Some bonds may be more difficult to sell than others, which can result in a lower price or longer wait time to sell the bond. It is important to consider the liquidity of the bond market before making an investment to ensure that you can quickly and easily sell your bond if necessary. Diversification is another important factor to consider when investing in bonds. As with any investment, it is important to spread your investment across a variety of bonds to reduce the overall risk to your portfolio. This can be accomplished by investing in bonds with different credit qualities, maturities, and coupon rates. It is important to have a clear investment strategy in place when investing in bonds. This may include a goal for your investment, such as building wealth or generating income, as well as a specific timeline for your investment. With a clear investment strategy in place, it will be easier to make informed investment decisions and achieve your financial goals. You'll need to decide how you want to invest in bonds. There are several options available, including individual bonds, bond mutual funds, and exchange-traded funds, ETFs. Each option has its own set of advantages and disadvantages, so it's important to consider your investment goals, risk tolerance, and other factors when making your choice. By following these steps, you can start investing in bonds and work towards achieving your financial goals. Whether you're looking for income, stability, or diversification, bonds can be a valuable addition to your portfolio.